Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host at AlgoBot, and today we're studying an expert advisor called Basis Convergence Arbitrage. This is a single-instrument statistical arbitrage system built around one simple idea. Measure how far price has drifted from its own fair value, then look for that gap to close again. Over the next few minutes, you'll learn how the strategy builds its fair value anchor with a moving average, how it turns the gap into a standardized signal, and how it manages entries, exits, and risk. Let's get started. So what exactly does this expert advisor do? At its heart, Basis Convergence Arbitrage is a single-instrument, mean reversion system that belongs to a family of approaches called statistical arbitrage. Classic arbitrage trades the spread between two related prices and collects the difference when that spread snaps back to fair value. Here, though, the engine works with one symbol on one time frame. So instead of a spread between two instruments, the strategy builds a temporal spread, the gap between the current price and the price's own synthetic fair value. That fair value is an exponential moving average of the close, and the gap between price and that average is called the basis. The strategy assumes that when the basis stretches unusually far in either direction, it tends to be pulled back toward zero, and it aims to trade that return. To make the signal consistent across quiet and busy markets, the basis is converted into a z-score, a standardized measure of how many standard deviations the current gap sits from its recent average. The natural home for this kind of approach is a liquid, range-prone market, such as a major foreign exchange pair like EURist on the 5-minute to 30-minute charts. That said, the expert advisor runs on whatever symbol and time frame you select at test time. It is best suited to traders who are curious about mean reversion and market-neutral thinking, and who prefer a rules-based system with clearly defined entries, exits, and risk controls rather than discretionary decisions. One important note before we go deeper. Despite the word arbitrage in its name, this is statistical arbitrage, which is not risk-free. The relationship it relies on can break. Dislocations can grow wider before they narrow, and losing trades are a normal part of the process. This video is educational information only, and not financial advice. Let's walk through the mechanics step by step. The expert advisor evaluates its rules once per freshly closed bar on the primary time frame, so it ignores the noise inside a forming candle and acts on completed information. First, it builds a fair value anchor. This is an exponential moving average of the closing price over the anchor period, which defaults to 50 bars. Think of this line as the market's rough equilibrium. Next, it measures the basis, which is simply the current close minus that fair value line. When price sits above fair value, the basis is positive. When price sits below, the basis is negative. This basis is the temporal spread the strategy tries to arbitrage. Because a raw gap means different things in calm and volatile conditions, the strategy standardizes the basis into a z-score. Over a rolling basis window of 60 bars, it computes the average basis and its standard deviation, then expresses today's basis as the number of standard deviations away from that average. A z-score of -2 means price is unusually cheap relative to its own recent behavior. A z-score of +2 means it's unusually rich. Now the entry logic. For a long, the strategy requires three things at once. The z-score must be at or below the negative EntryZ threshold, which defaults to -2, so price is statistically cheap. The basis must be curling back up, meaning this bar's basis is closer to zero than the previous bars, confirming the gap has started to close. And the regime must be flat. Here's the core of the MetaQuotes language code, shown the way you'd see it in MetaEditor. At the top are the input parameters, and these map one-to-one with the settings we've discussed. AnchorPeriod is the 50-bar exponential moving average for fair value. Basis window is the 60-bar window used to standardize the basis into a z-score. EntryZ, defaulting to 2, is how many standard deviations of dislocation we require before considering a trade, while ExitZ, at 0.4, defines the convergence band where we close. Slope lookback and MaxSlopeAtr govern the flat regime gate. ATR period, stop ATR multiple, and TP-ATR multiple control the volatility-based stop and target. Max spread points blocks entries when the spread is too wide, and lots and magic set the order size and identifier. Below the inputs are the two signal blocks. The long block reads, if Z is less than or equal to minus EntryZ, and the current basis is greater than the previous basis, then the setup is valid. The code reads the ask price, sets the stop loss a stop distance below entry and the take profit a target distance above, and calls trade.buy with the lot size and those levels. The short block is the mirror image. If Z is greater than or equal to EntryZ, and the current basis is less than the previous basis, it reads the bid price, places the stop loss above entry and the take profit below, and calls trade.sell. Notice that both sides normalize their prices to the symbol's digits, and both attach the stop and target at the moment of entry, so risk is defined before the position is even open. Let's bring the whole strategy to life on a chart. On screen, you can see a candlestick sequence for a Euro-style market. The blue line running through the candles is the fair value anchor, our exponential moving average. And in the panel below, price is the basis Z-score, with dashed levels marking the +2 and -2 entry thresholds in red and green, and a narrow gray band near 0.4 where convergence is recognized. Watch how the two work together. We open with price hugging the fair value line and the Z-score sitting close to 0. There's no dislocation here, so the strategy simply watches. On the next candle, price begins slipping below fair value, and the Z-score dips toward -1. Still not enough. Then comes a sharp down candle. Price pushes well beneath the fair value line, and the Z-score drops through the -2 threshold into the discount zone. Price is now statistically cheap. But notice the strategy does not buy yet, because the basis is still widening. The gap is still growing, and grabbing a spread that's still stretching is exactly what the turn confirmation gate is designed to prevent. On the following candle, the picture changes. Price ticks back up, the basis curls towards 0 for the first time, and the Z-score, while still below -2, has started to rise. Now all three conditions line up: deeply cheap, basis turning up, and a flat fair value line signaling a stable regime. This is where the buy entry marker appears. The strategy places the order, and at the same moment it attaches a stop loss 2 average true range units below and a take profit 1.5 units above as hard safety rails. From there, price does what the strategy is betting on. It converges back toward fair value. Candle by candle, the gap narrows, and the Z-score climbs out of the discount zone toward the center. When the Z-score settles inside the exit band around 0.4, the dislocation is considered resolved. The convergence exit marker shows the position being closed as price meets its fair value once more. That's the full long cycle. Buy the discount, ride the reversion, and bank the convergence. Now watch the mirror image unfold. After that reversion, price keeps pushing higher and overshoots to the upside. It rises well above the fair value line, and in the panel below, the Z-score climbs through the +2 threshold into the premium zone. Price is now statistically rich. Just as before, the strategy waits. On the strongest up candle, the basis is still expanding, so no order is placed. Only on the next candle, when price rolls over and the basis begins curling back down while the Z-score is still above +2, do the conditions align. The sell entry marker appears. The strategy sells the premium, placing its stop loss 2 average true range units above and its take profit 1.5 units below. Then convergence works in the other direction. Price drifts back down toward fair value. The Z-score falls out of the premium zone and back toward the center, and once it re-enters the exit band near 0.4, the second convergence exit marker closes the trade. Price and fair value have met again. Step back, and you can see the rhythm the strategy is built to study. It is not trying to predict big trends. It waits for price to stretch unusually far from its own equilibrium, insists that the stretch has begun to reverse, confirms the background is calm rather than trending, and then trades the return to fair value. The Z-score keeps every signal comparable across calm and volatile stretches, while the average true range stops define risk on each position. Remember, statistical arbitrage is not free money. The relationship can keep widening, and losses do happen when it does. And that brings us to the end of our breakdown of the Basis Convergence Arbitrage Expert Advisor. Today we covered how the strategy builds a fair value anchor with an exponential moving average, how it turns the gap from that anchor into a standardized Z-score, how the flat regime and turn confirmation gates filter its entries, and how convergence exits and average true range stops manage each position. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do occur. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.